So SM REIT, the government saw the positivity on the REIT structure per se.
Right.
Why not permit in a manner that is ring fenced, is regulated? Because in India, as you and I know, there are a lot of schemes that come out. People, if you see all the schemes that have got into trouble, all of those schemes are to buy real estate. If they're not regulated, there were a lot of examples of people losing money, etc. So there is the appetite, there is the money in the market. Why are we keeping one class of holder of assets away from the ability to monetize?
Especially with all the IPOs happening today in the markets, I think there are lots of people who are sort of making a lot of capital gains, and they want some advice on how to make sure that they're on the right side of the law.
The nature of HNIs has changed over the past 10-15 years.
Right.
Previously, we had large business families, and now we have professional startup entrepreneurs who are all professionals by and large,
Right.
who are getting those exits, who are getting those valuations, and are becoming HNIs. Equity strategy itself is not sufficient, and given the heating up there, a lot of them are looking at real estate because that's the next big class of asset, equity, which has its own risk profile, which can give you the huge upsides, but can take away a lot of your money.
Right.
Vis-a-vis a real estate asset that gives you reasonable upside on the property plus a regular income earning, and if you hold that for 5 years, your yield rates significantly improve. So if you're holding units of a REIT, whether it's SM REIT or it's a main board REIT, you will have a 12.5% tax when you sell the unit if you've held it for more than.
Which is great. So if the REIT stock price goes,
I think the bank should be worried, as in this is an FD kind of an asset, right?
Yeah.
You have it curated, you have it managed, you have it governed, and then you get 5% plus. The equity value will remain.
These sort of assets in the past, 100, 200, 300 crores, we know they were very lucrative because it gave you 8-9% returns on a monthly basis. It was hedged with inflation because the rent itself goes up by 5% a year, 15% every 3 years. Plus you get capital appreciation on the products. It's a very hybrid sort of instrument. You've got debt sort of returns plus the upside of equity making you 13-14% return. And HNIs have sort of known this, and they have been investing in this asset class for long periods of time. But now suddenly you're making this available to the normal retail guy on the street. Tax is one of the most important things to consider while evaluating returns from any asset class, whether it's equities, fixed income, or alternates like real estate. However, investors often disregard tax and focus on gross returns, which can lead to suboptimal decisions in the long run. This is especially true in a country like India, where tax changes happen frequently, as we saw in the recent budget. Hello and welcome to this episode of the PropShare Podcast series. Today we are in conversation with KT Chandy, tax and regulatory partner at Ernst and Young. He has over 25 years of experience in succession planning, corporate tax, private equity, venture capital, merger and acquisitions tax, and cross-border structuring. Chandy, we've worked for a long time together. Welcome to the podcast.
Thank you, Kunal.
Like I was saying, we've sort of known each other from Blackstone days, 2007, 8, 9, seen through a lot of regulatory changes in real estate, tax, etc. I mean, you've obviously seen even more, but today we're going to focus a little bit on tax, also on the new SM REIT structure that SEBI has kind of come up with. But before we start, tell us a little bit about how you started your career in tax, regulatory advice, what led you to tax, and how it's been going so far.
Yeah. So thank you, Kunal. Thank you for having me here. So I'm an chartered accountant, did my articleship with a firm called Arthur Andersen.
Okay.
And I've remained there. We merged with EY in India after Andersen went down. And I've been in tax and regulatory for this past 25 odd years.
You're a career Ernst and Young.
Ernst and Young.
I don't think, are there any people who've been in Ernst and Young longer than you, or it's a very select group of people?
So quite a few actually. Ernst and Young that way has has a lot of partners who have come through the ranks.
Right.
So I did my articleship in Bombay, and if I go back to Bombay, the people I did my articleship are there in Bombay.
Are still in Bombay in Ernst and
So
Young.
it's
Okay, that's good.
It's a wonderful family kind of. You
Right.
feel part of a.
Right, right. And what do you focus on right now? What's your primary focus in Ernst and Young these days?
So I co-lead a practice called the private tax practice.
Okay.
And there we deal with lots of the private pools of capital. So
Right.
venture funds, the GPs, the startups, the to-be listed entities, succession planning for all of the people in this group,
Right.
so on and so forth. And it's the hottest topic today, all of these.
It is, especially with all the IPOs happening today in the markets. I think there are lots of people who are sort of making a lot of capital gains, and they want some advice on how to make sure that they're on the right side of the law. And I mean, you mentioned a lot of HNI clients that you've been advising. How big a role does real estate play in their portfolios? Is that a big portion of what they do traditionally?
So it's a good question, Kunal. And as you see, the nature of HNIs has changed over the past 10, 15 years.
Right.
Previously, we had large business families.
True.
And now we have professionals, startup entrepreneurs who are all professionals by and large,
Right.
who are getting those exits, who are getting those valuations and are becoming HNIs.
Right.
So if you look at these two buckets of HNIs, two different types of HNIs, the old HNIs, they're all largely invested in stocks
Right.
or in real estate. These are the two primary assets. The newer HNIs, real estate used to be a difficult proposition in that they didn't have the bandwidth, the family support, the offices that you have when you are in this first bucket that I mentioned. So they were going slow on that. They were limiting themselves to residential, large residential, so on and so forth. But today I see the quantum of wealth. When you have a particular quantum of wealth, real estate is an asset where you can deploy your wealth.
Right.
And equity strategy itself is not sufficient, and given the heating up there, a lot of them are looking at real estate because that's the next big class of asset.
Right.
So that's a very active conversation.
So it does play a big role in their portfolios, but the type of real estate assets you're seeing has sort of changed a little bit. What the old families used to do versus what the new age entrepreneurs are sort of investing in real estate. Just talking about tax, the recent budget sort of came up with a lot of different changes in capital gains tax, and people are quite confused, and they went back on a few of them now. What are the primary 2-3 takeaways on the new tax regime that the government has come up with?
So I think the government looked at the entire capital gains tax regime,
right,
and they found multiple asset classes having multiple different types of treatment: short-term, long-term, period of holding, cost of assets, so on and so forth.
Right.
So they looked at this and said, aren't there too many rates? Aren't there too many provisions?
Right.
Let's just synchronize this, harmonize it.
Yeah.
So with that in mind, they have. And there was, non-resident investor, non-resident capital gains earner, resident capital gains earner, so on and so forth. Period of holding, 36 months for some, 24 for others, etc. So they have harmonized this whole thing and said long-term listed is 24 months. Short-term unlisted residential gold, everything else is 24 months. There's no 36 anymore.
Long-term listed is 12 months.
Long-term listed is 12 months. Right. So previously, REIT units were 36 months.
Even though they were listed, they were 36 months, which is sort of weird because they are also listed like any stock, but for them, for some reason, it's 36 months, whereas for the listed stocks, it was 12 months. So that was a good win for the REIT industry. So now what they're saying is everything that's listed is 12 months is where they become long-term,
yes,
at which point of time you pay 12.5%, and the whole concept of indexation is gone,
yes,
at least in their initial thing. And if you sell anything which is held for less than a year, whether it's a stock or bond, private company shares, it's short-term capital gains, and that is what is it now?
So for listed, it is 20%.
Yeah.
For unlisted, it is our
marginal
tax rate.
Right.
Marginal tax rate.
So if you sell a listed, whether it's a bond or whether it's stocks, it is sort of less than 1 year, 20%.
That's right.
And anything above 1 year is 12.5%.
That's correct.
And this indexation has been a big sort of thing that people have been saying, look, that's something you can't get rid of. Why was there so much angst on this indexation?
So indexation on listed, if you were taking the 10% old tax rate of 10,
Yeah.
you didn't get indexation anyway. It was,
Right.
If you take the 10, you don't get indexation.
Yeah.
So listed stocks and securities are one,
Right.
because the tax rate was lower.
Right.
But when you come to unlisted, you had the ability to index.
Right.
Now for long term, they have brought the rate down from 20 to 12 and a half.
Right.
So hopefully that gives some of the indexation.
Yeah.
And long term equity unlisted is not held for too long. It's not held for 20, 30 years.
Right.
Typically,
Right.
it comes into the market and goes into a listed space, etc.
Right.
The challenge was in people who owned house property.
Yeah.
So what was the tax regime? The tax regime was if you bought it in the 60s, you could take your value up to 2001 gazetted rate.
Yeah.
And beyond that, they used to give you an indexation based on inflation.
Yeah.
And from 2001 to today, it's about 4 times.
Right.
Just under 4 times. But if you take away indexation and say I'm getting your rate down from 20 to 12,
Yeah.
people were out of pocket.
Right.
And that was the great push back.
Right.
Which the government heard and said, for properties purchased before June 23rd, whatever, of 24, you can opt to take indexation, but you pay tax at the higher rate.
Right. And what's the higher rate?
20%.
20%.
The old rate of 20%.
You can choose which one you want to do, I
You
guess.
can choose which one you want. And I suppose this is a, they'll take this on for a few years and then relook.
Slowly phase out the part about you having the option of using the old sort of tax regime.
See, I don't know how they can phase it out because these are all meant to cover old historic assets.
Yeah.
Where gazetted value in 2001 may not approximate the fair market value. So then
Right.
you're stuck with, you bought a house of 1,000 rupees in 1950
Yeah.
in Worli, for example.
Yeah.
2001, the gazetted rate may be, even if it's 10 lakhs, the fair value would have been 10 crores. So
Yeah.
that was the challenge.
Yeah, right. So 12.5% makes more sense for you in that case than 20% because indexation is not really adding much to your value for 1,000 rupee sort of.
1,000 is an extreme
As in
example,
for someone who bought it in the 60s, 70s at a very low sort of price because most of the capital appreciation has happened post 2001.
So again, they've given people the ability to choose. So I
Right.
think that has put this noise down.
Okay. And for private company shares, it's pretty straightforward now. More than 1 year is long-term capital gain, and less than 1 year is short-term.
More than 2 years.
More than 2 years. For listed, it's 1 year.
Listed is 1 year.
Right.
Otherwise, it's 2 years. And if you go listed, a private going listed, when you sell, your entire period of holding is considered when you are private as well.
Right.
And it's only 12 months.
Okay, so for example, an IPO, I guess, right?
Yes.
So let's say the Ola IPO that recently happened. If you formed that company 4 or 5 years ago, but you're going public now, that 5 years will be counted as a publicly listed sort
If you
of.
sell it once, it's listed.
If you sell it once it's listed. Even if you sell it the next day of listing, you are still in a long-term
Yes.
capital gains tax, despite having only owned the public stock for 1 day.
That's
Right,
true. That's true.
Right. And on NRIs, there used to be, the NRI capital gains tax was lower, but no indexation earlier, 10%. So is that also now part of the same regime?
So it's now, so the big problem or the big push from the domestic investors was that we are sitting in India, we are investing, you're giving us a 20% tax rate on
True.
private. People coming from overseas, you're giving a 10% tax rate.
Yeah.
Now, why did we give the 10%? It was historically you needed that amount of capital, so on and so forth. But now that the capital has built,
Yeah.
the ask was, can you please equate the tax rate?
Right.
So 20 has come down to 12 and a half.
Right.
To make up for that, the 10 has gone to 12. So
Okay.
everybody is now at the
So
same.
now whether you're an NRI or a resident, it doesn't really matter. If you are selling shares, you have to pay 12.5%, which in a way is good. It kind of rationalizes the entire
Absolutely.
tax sort of structure. Talking about REITs, because that's the industry that we are in. Talk us through what was happening in REITs before. I know you touched briefly on it, and now sort of what are the changes and why is it a positive?
On the SM REIT versus the main
Even
board
REITs is almost the same thing. Like the holding period on units. What was that whole thing?
So, for listed shares, the Income Tax Act defined it as equity shares, etc.,
Okay.
and left out units of in those days, units of InvITs, REITs, etc., were not available,
Right.
and therefore you fell in other asset class, and therefore caught the 36-month long-term versus short-term.
Right.
All of that has been aligned now. So if you're holding units of a REIT, whether it's SM REIT or it's a main board REIT, you will have a 12.5% tax when you sell the unit if you've held it for more than.
Which is great. So
Absolutely.
if the REIT stock price goes up by 20%, you only pay 12.5% of 20% instead of waiting for 3 years like earlier to get that 10%.
Absolutely.
So that's a pretty big positive.
It's a huge positive
For the REIT and the SM REIT industry. Right. So, I mean, talking about SM REIT, can you tell us about what this new SM REIT regulations is all about? I know that the regulatory side of tax and real estate is also something that you've been following for a very long time, and ENY is part of the working committee group with SEBI on REITs. So, what is this new SM REIT regulations? Why have they kind of come about? What is SEBI thinking here?
So SM REIT, the government saw the positivity on the REIT structure per se.
Right.
At the same time, they were looking across the country and saying there are multiple small properties which may not find its way into a main REIT. You may
Right.
get lost in the main REIT, the
Yeah.
type of assets there, the class of people you want to invite.
It's not even allowed because 500 crores, you have to be a minimum of 500 to be in the REIT. So there's a bunch of assets below 500 you're talking about.
Bunch of assets below 500, and even if you throw your assets, the owner of the asset becomes a very small shareholder.
Right.
He gets lost in the whole scheme of things. He doesn't have a say, so on and so forth.
Right.
And the government was looking at, there may be these large tech parks, etc., but there are a lot of great properties, in historic parts of India, in developing parts of India, in developed parts of India, where is it fair to keep them out of this whole growth of monetization,
Yeah.
this whole ability of monetization?
Yeah.
So why not permit in a manner that is ring fenced, is regulated? Because in India, as you and I know, there are a lot of schemes that come out. People, if you see all the schemes that have got into trouble,
Yeah.
all of those schemes are to buy real estate. It's not too much.
Ultimately it's monetization of real estate,
Yes.
which people are trying to do. But since it was not regulated, it was a bit of a problem.
Since you're not regulated, there were a lot of examples of people losing money, etc.
Yeah.
So there is the appetite, there is the money in the market. Why are we keeping one class of holder of assets away from the ability to monetize?
Right.
And therefore the 50 to 500, therefore the ownership of that asset, therefore, keep away related party transactions. Don't let developers come in and use it. This is for regular investors,
Single asset owners.
Yes.
And how does it contribute to capital in the economy in general? How does that work?
So it's a significant unlocking of value.
Right.
Like you and I know, the SIP inflows.
Yeah.
The data talks of 25,000 crores.
Right.
Where is that 25,000 crores going? Is it
Yeah.
all going to equity, which
Yeah.
has its own risk profile,
Yes.
which can give you the huge upsides, but can take away a lot of your money.
Right.
Vis-a-vis a real estate asset that gives you reasonable upside on the property plus a regular income earning, and if you hold that for 5 years, your yield rates significantly
Right.
improve.
Right.
So as the government looks at all of this and say, which are the other papers
Yeah.
that is available? Isn't this a great paper for a smaller investor to come in, for a
Right.
larger investor to come in, whoever?
Right.
And I think that they've thought through all of this.
They have. So from an investor point of view, what you're saying is, look, I have a new way to securitize an asset, which has traditionally been just lying there. Someone's been owning it, but it's not really been monetized. So he gets, instead of investing in only one or two asset classes, he has now the option of investing it in rent yielding real estate, which is safer. You could also get capital appreciation. From the point of view of the person owning this asset, he suddenly gets 300-400 crores of capital,
Yes.
unlocks that value, and now suddenly he can use that to do other things like buy more land or invest it in other capital market products. So therefore the circulation of capital in the economy itself goes up in a big way. I think that's one of the bets that the regulator is also taking here, a longer term expansion of capital and GDP of the country. And I don't know if you saw, but CBRE just came up with a report on SM REITs last week, and they mentioned $60 billion worth of assets less than 500 crores only in the big tier one cities. Do you agree with sort of that sort of a number?
So 60 billion, and I'm sure CBRE has done primary
Yeah.
research, but 60 billion, if anything, may be an understatement.
That's what I also feel, exactly.
Because this is not only grade A, right?
Yeah.
This is, and if you look at Bangalore, and you know all of this better, it's, the large investors come to grade A, they want to see grade A, but grade B is earning equal amounts of rent, proportionate to their capital value, etc.
Yes.
So developing productive capital, getting more people to participate, other than only the most sophisticated. I think all of this is, it's a great thing.
Yeah, that's another good point, because these sort of assets in the past, 100, 200, 300 crores, we know they were very lucrative because it gave you 8-9% returns on a monthly basis. It was hedged with inflation because the rent itself goes up by 5% a year, 15% every 3 years. Plus you get capital appreciation on the products. It's a very hybrid sort of instrument. You got debt sort of returns plus the upside of equity making you 13-14% return. And HNIs have sort of known this, and they have been investing in this asset class for long periods of time. But now suddenly you're making this available to the normal retail guy on the street. So that's something that's quite commendable, I guess. So that's,
I think the banks should be worried, as in, this is an FD kind of an asset, right?
Yeah.
You have it curated, you have it managed, you have it governed, and then you get 5% plus. The equity value will remain.
Right. The other reason I feel that SEBI came up with the regulations is also the fractional ownership platforms, right? So including us, who sort of pioneered it in 2014-15. What kind of role do you think people like us played in the SM REIT regulations?
I think if you take PropShare, and I'm not saying this because I'm talking to you, but if you take PropShare, they in some ways created this whole market and this awareness. And if somebody has studied how you've done it, the speed with which you can get an asset invested in, open people's eyes, including regulators, on the quantum of money there, and the desire to own these assets.
Exactly.
I want to own, but I can't buy 400 crores. I may be able to buy for 2 crores. Give me an opportunity. So I think PropShare has done a great thing, and I know that PropShare has also been discussing with SEBI on policy that as you get bigger, you're better served by having it regulated.
Of course.
So you know the boundaries, and also the government started seeing these. See, there are people who play by the rules, and then this. Then fractional ownership gets into to be built fractional ownership, and then it's
then
chaos,
you go into land, then you never know what goes into what happens. So it's better to sort of regulate the market, make sure that the fees are the same, the marketing is the same, and people just don't go sort of slightly overboard on these things. Thank you so much. Of course, also we worked together for a long time when we started off the structuring of the whole sort of fractional ownership platform, how to give investors returns, the whole CCD structure that we came up with back in the day, which was then mirrored by many other sort of platforms. I think, like you said, what we told the regulator is there are enough number of people who want to do this. You can see the demand. The industry is showing you that, and therefore now is the time to regulate it so that it goes even bigger, because there's no way to achieve scale in investment management unless you are regulated, and you can get distributors, wealth managers to then come and start selling your products across the country, because till now it's only been online. And in terms of taxation, I know we spoke briefly. How are SM REITs taxed? So if we look at, I can see two sources of income. One is the rental income, which gets distributed in a particular way. There are various options, and then there is the capital gains, right? So capital gains we sort of answered by saying if you hold it for more than a year, it's 12.5%. If you sell it less than a year, it's 20%. On the rental income, how is rental income taxed in the hands of the investor of the unit of this SM REIT trust?
So they acknowledge, the structure that SM REIT requires is that you have a REIT, which is a trust that is listed, and the trust needs to own an SPV, being a company alone.
Yes.
So you have a company earns rent. That rent depending on what tax rate you pay, whether you take the beneficial tax rate
Yeah.
or you take the normal 25-30. Now, there's a small anomaly in the 25 and 30, which will get ironed out. I'm
Yeah.
sure the government is looking at it. But let's say you go for the normal tax rate. Once you go for the normal tax rate, then the dividend that you declare is not taxable in the hands of the REIT, and neither is it taxable. It will be a dividend outflow. Let's assume you only have equity and no loan instruments remain. Then the outflow will be rent earned subject to tax, net of tax declared to the REIT. And the rule, and again, the government has thought about it, the regulator has thought about it. 95% of your net earnings in the SPV has to be declared upstream.
Yes.
So you have to send that money out. You can't buy the asset, promise something, and not send it.
Yeah.
95% goes out of net income to the REIT, and the REIT, whatever it gets, 100% it has to send out, distribute. That dividend is not taxable in the hands of the final investor.
Right.
And now, if you take the beneficial regime, then you pay tax, but the dividend is taxable in the hands of the ultimate.
So the beneficial regime is where you pay lower corporate tax, right? Versus the earlier regime where you paid a slightly higher tax rate.
That's correct.
So just to sort of one place I would correct you is instead of the REIT, I would say the scheme, because in this case there are multiple schemes which are the trust. So the scheme owns the SPV, SPV owns the asset, asset gives the rent to the SPV, SPV upstreams the rent as dividend, let's say, to the REIT unit holder, the scheme unit holder. That is completely tax free,
provided the normal tax
provided you are in the non-new tax regime. Now, but that's not the way that REITs have been doing it so far. They also have other components like interest, return of capital. So let's say I upstream it as interest, like the way we've been doing on the platform, where you are a CCD holder. So SPV is the SPV investor is a CCD holder in the SPV that owns the asset. Asset gives a rent to the SPV. SPV then gives an interest to the investor. So if the SPV gives an interest to the scheme, the trust, then what happens?
So again, that's a good point. And structure-wise, you may not have too much interest flowing basis what the regulations talk of.
Yeah.
But let's say you are able to develop an OCD or whatever between the scheme and the SPV.
Right.
Interest will flow to the scheme.
Right.
Scheme does not pay tax. Scheme is transparent.
Yeah.
But that interest will be taxable as regular income in the hands of the unit holder.
Okay.
And why would that be? Because you would get a tax deduction at the company.
Right.
So some party has to pay this. Dividend, if you look at it, it is post-income tax paid.
Yes. So what you're saying is that the SPV has a rental income and it's showing interest as an expense and therefore is not paying any tax. Yes. So at some point of time there has to be a tax. Somebody has to pay the tax. That's the whole philosophy behind tax. And then will there be TDS as well for a listed scheme or trust?
There would be the 10% that
10% TDS,
which
it's a timing problem.
It's a timing issue.
And then the REITs also do return of capital, right? So how is that sort of taxed?
So law got amended. We have to talk of the past before we come here. So there were all of these, interest flow back, dividend flow back, etc., which were addressed. Now, a lot of people had excess cash flow in the company that they were not declaring as dividend because it was not dividendable, for example, depreciation, etc. They were returning capital value.
Right.
So when you return capital value, the argument being taken is this is not taxable. I'm returning, somebody has invested 100, I'm returning 50 of that 100. So it is not taxable at all.
Yeah.
And then that unit holder was selling his unit whose cost was 100 and remained 100 and getting the beneficial tax rate of capital gains.
Right.
Let's say 10% if you held it for 3 years.
Right.
So the government came back and said that 50 is not subject to tax. What has happened to that 50?
Yeah.
So they've amended the rule to say when you pay back this, if your cost of acquisition is 100 and you get 50, your cost of acquisition comes down by 50.
So that capital gains tax becomes applicable.
The capital gains tax becomes applicable only when you finally sell the units.
But then, the SPV has given, the trust has given a loan to the SPV.
Yes.
Right? And the SPV is paying back this loan.
Yes.
And the units that are listed, you're saying their cost of acquisition
of the
unit will become lower by that amount. So when you sell the units on the stock exchange, you will be taxed, your cost of acquisition will be lower, and therefore
Yes.
you have a higher capital gains tax.
That's correct.
Even then you pay 12.5% instead of the 39% if you're in the higher tax bracket. So it's still sort of
It's still beneficial,
beneficial.
but if you look at the government's point of view, they're not losing, right?
Yeah.
This was 50 was the capital you put. You would ordinarily have got
course.
it as capital gains.
Yeah.
You were planning this scheme in this manner, such that you did not pay tax at all.
Okay.
So now saying keep reducing. Suppose your cost is 100 and they pay back 200,
Yeah.
whatever extreme. That balance becomes taxable immediately, and
Right,
your cost
right.
becomes zero.
Right. So when you distribute return of capital, there is no tax. But the moment you sell the unit on the capital gains, there is a slightly higher tax because of the reduction in cost of acquisition. That's what
correct.
ultimately it means.
But what happens, Kunal, is if your cost is 100 and you return 120,
Yeah.
then that 20 gets taxed as capital gains
Capital
immediately.
gains immediately, right? Even then it's 12.5%. So it looks like it's a little more favorable from an investor point of view. What do you see as the key challenges to this SM REIT regulation? We've been very closely involved with the SM REITs. We've seen a few challenges, but what have you seen so far that you think will be a challenge that the regulator might have to work on?
So I think there are two, three parts, and as all regulators, they bring in regulations to catch the extreme cases, those who are trying to take advantage of a situation. So if you take two, three aspects, the first is it has to be 100% equity.
Yeah.
Why not some other instrument one to the other?
Right.
Can it not be CCD, so on and so forth?
Right.
But now that they've come with equity, they will stay with equity. I don't think they will change that method.
Right.
Only migration gets hampered.
Right.
Because there is a structure that is there,
Right.
which is CCDs, and if you flip CCDs, flipping an asset into a REIT on shares is exempt from tax. You
Yeah.
don't pay tax. But if it is CCDs, you pay tax.
Yeah.
So you'll have to change your entire structure, get the approval of all your shareholders,
Yeah.
unit holders, etc. So that is one government has to think of. For migrating assets, do I let it remain as is?
Right.
Then is the 10 lakh size.
Yeah.
Now, you can think of a unit being 10 lakhs versus 10,000 under the main REIT.
Yeah.
And what was the thought process? Probably the regulator thought of these will be smaller unit holders, but at the same time, I don't want the smallest unit holder to come.
Yeah.
I don't want a retail shop to own it.
Yeah.
So they came up with a 10 lakh number. Now, does the 10 lakh constrict some people? Can it not be a 5 lakh number? So
Yeah.
that's, I think, something that one has to think about.
Right.
Then ownership of the asset. You need to own 100% of the asset.
Yeah.
You need to fully understand the logic of that. Why should I own complete 100%?
Yeah.
And particularly in assets that are bought with under multiple names, and there are various reasons for ownership. In inheritance, there would be multiple people on it till it is divided and
Yes.
passed over. So there again, if the regulator were to apply, case by case discretion, that would be very useful. So that more assets come into this pool. By
Right.
putting these conditions, are you limiting the number of assets that can get into it, and therefore harming your entire objective?
Right. Right. What do you think about the process of these SM REIT regulations, the way it was sort of brought in? Do you have any?
I think, as and you know this better,
Yeah.
Kunal, you led the policy discussion.
I don't think I led the policy discussion,
you
but
were-
I mean,
you
yeah,
were
we were
very
one of the
involved.
larger players.
You're
Yes.
very involved. I think this is one of the regulations where you've got the maximum input, the FAQs that came out, the gray areas that were solved.
Yeah.
So the fact that they came out with an SM REIT,
Yeah.
itself
Yeah.
shows that we are listening to the
Yeah.
market.
Yeah. Yeah.
And then once you come out with it, to hear the challenges and the FAQs, there were 18, 20,
Yeah.
24, answers.
Mm-hmm.
I think the process has been wonderful.
Yeah.
And that process gives you comfort that if there are more teething challenges or there are more issues that are not making logical sense,
Yes.
SEBI will look at it.
Yeah.
And
Yeah. I feel that you're absolutely right. I felt like SEBI did an amazing job of these regulations. First, in the way how consultative they were with the industry. A
Yes.
first paper, then a second consultation paper,
Yes.
and then some discussions, then a lot of these closed door meetings, in different cities with the key players, trying to understand what their issues were, and then finally sort of trying to they have of course they have to also wear the hat of investor protection and making sure that the corner cases are protected, like you mentioned. But I think they led a very consultative process and came up with a very good set of regulations for the industry. I mean, some of it is harsh, of course, 20 crore net worth, 5% in every single asset, and some of the requirements on independent board members, the same as the main board REITs. Despite you being much smaller, you have to have a 6-member board, 3 independent members, related parties completely not allowed, and so on. But these are things that can be watered down or diluted over time once you see how the market is sort of responding to these regulations. Even the REIT regulations came in 2014, but the first REIT only came out in 2018. And therefore, I feel like they have really done an excellent job, because when a sector gets regulated, you can either sort of kill the sector and make it very, very, it's almost impossible to operate. Like, for example, let's say the CIS regulation. There is no CIS ever registered, right?
Correct.
That regulation was brought about for enforcement more than for proactively getting people to be regulated. If I were to give the P2P lending regulations, they were very, very strict from RBI, and therefore it more or less it sort of hampered the scale at which you could operate. But over here, I think SEBI has done a very good job of not sort of killing the industry, at the same time fostering growth to make sure that this sort of goes and becomes bigger. So I think that way they've done, I agree with you that they've done a very good job. Where do you see this sort of industry heading now? There were lots of fractional ownership platform, tens in fact opened over the last few years, and now that this is regulated, there are some strict regulations around marketing, hiring a merchant banker. The process very process driven now. Where do you see this sort of industry heading?
I think, Kunal, you referenced the point of multiple fractional ownership coming into play.
Yeah.
And as multiple come into play, you dilute some of the criteria.
Yeah.
You get into unbuilt space, pure land, so on and so forth.
Yeah.
Which again, you reference the CIS regulations,
Yes.
right? That they came in to stop all of these practices.
Yes.
So therefore, by giving a framework and by saying you can own only let out property, no unbuilt, you need to be 95%
Yeah.
whatever in rental
Yes.
property. That I think they are creating that faith in the market. An investor who comes in will not lose money.
Exactly.
The property is not built, I've not got a tenant, I'm not earning for 10 years.
Yes.
Here, the day you put money, rent theoretically is available. You have to distribute your money quarterly. You have to distribute dividends quarterly, not semi-annually. So I think this industry is going only one way, and they have possibly nipped extreme practices in the bud by
Yeah.
putting regulations.
Absolutely.
Before it goes too bad, and then real estate is just coming out of this whole tar of being associated with black money, so on and so forth.
Yeah.
So by getting regulations, by getting professionals to run it, you're actually changing the nature
Yeah.
of.
By securitizing the asset, you are sort of bringing it into the whole public regulated space. You are getting rid of some of these stigmas that have been attached to the sector for the longest period of time. There, I think we absolutely agree that this industry is going to definitely go on a very steep trajectory of growth over the next few years. So, I mean, as you might be knowing, we received the first SM REIT license, and we are trying to get the first scheme going as well. So we'll be a big part of this process, and I'm hoping that we will sort of continue to work together and grow this business over the next few years. Great. On that note, Chandy, thank you so much for joining our podcast. It was a pleasure speaking to you as always.
Thank you, Kunal. Thank you for having me.
Thank you very much. All right. I hope you guys enjoyed that conversation with Chandy. I hope it was not very technical on the tax. If you have any questions, please feel free to write to us. But until next time, thank you so much for attending this podcast, and we'll see you next time. Thank you.